TD Ameritrade's Investor Movement Index, or the IMX, indicates that clients were net buyers of equities in the month of July. JJ, let's review some of the stats here.
Sure. They were buyers last month, and I think it takes people by surprise a little bit considering some of the rockiness we saw in July with Greece, et cetera, at the beginning of the month. But one of the things you have to keep in mind is we also had earnings. And in earnings, Apple got hurt. Apple was the #1 traded stock at TD Ameritrade last year, the #1 held stock at TD Ameritrade last year. So when you see a stock like Apple get hit, many of our clients are going to use that as a buying opportunity. The other thing that happened last month that people may not remember is Netflix split 7 for 1. At over $700, unaffordable stock for many people. At $100, a lot more affordable, and this is a product like Apple that people are very familiar with, they tend to have good interactions with, so they want to own the stock.
So the market's really in that range that it's been trading in for all of 2015. Was there a lot of asset reallocation? Yeah,
there was, Jill, and I talked about a couple of the stocks they bought, but they sold stocks that actually had a little bit of a pop. So stocks like Google, which really enjoyed a big pop last month, our clients decided to sell. With that, we saw MasterCard, Citigroup, some of the stocks that did well in earnings. Some of them we saw our clients accumulate back in February and March. And now that they had an up move, they decided to reallocate that capital for maybe some of the stocks that were beaten up a little bit more. The energy sector was very, very popular last month. Now, those are stocks that often people tend to hold for a longer period of time. But B, it's a way to synthetically play the price of oil without having to go out and buy the future. So I think that combination is one of the reasons people bought them.
So in terms of the energy stocks, do you think that the pain is basically over here? Because there was a lot of bullish commentary over the weekend in Barron's and other publications that they think you're going to start to see a bid in the oil sector. My concern is if you look at it from very core economic fundamentals, way too much supply, not enough demand. We're going into the shoulder season where refineries are going to shut down anyway and there's less consumer demand. Do you really think it's everyone getting on board just because the price suggests better valuation?
Yeah, it was kind of interesting, Jill, how from 4 p.m. New York time on Friday until that landed on your doorstep Saturday morning, everything seemed to turn around in terms of oil. But, for the short term, I think crude may have been a little bit overdone. I do agree with your longer-term concerns in that there does seem to be a bigger supply out there. You have more suppliers perhaps coming to the market in the Middle East now with what's going on with Iran, et cetera. So it'll be interesting to see if they slow some production or if we continue to provide bigger amounts of production, if that affects the price of oil. And also don't forget the other big concern, I think, is China's continuing slowdown and less demand for energy.
Well, I don't think we're really going to see the energy turnaround in terms of related stocks until we get some industry consolidation, because that's really the only way you're going to dial back on the producers. But on the theme of commodities, how do you feel about gold right now? Because typically in Q4, China dials up their demand.
They do, and we'll see, again, China's such a wild card, and it really, as you and I both know, it's very difficult sometimes to get your arms around what's actually going on there. But if you look at some of the other places, I don't foresee China having the demand for gold that they have in past years, only because all the other numbers I see around there point to a bit of a slowdown. Now, again, their GDP is still in the mid-7s, which I think our country would absolutely love to have.
Right.
But, I think at the end of the day, I do think you have to take those numbers with a little bit of a grain of salt. Yes, gold may enjoy a little bit of a pop, but right now, there doesn't seem to be the safe haven type thing around gold right now. And in terms of manufacturing, et cetera, it's muted at the moment, so we'll have to see.
It seems to be as if the U.S. dollar and the U.S. equity market is the safe haven. Do you think we'll continue to trade in this range for the remainder of the year?
There's no reason, if you look at the S&P 500, the SPX, we've traded between basically 2,060 on the downside, 2,130 on the upside. Since April 5th, it's been about 10 trading days, 9 of which were in a row. There's no reason, we always hear the trend is your friend. Well, you got to continue to trade this trend unless something major happens. If the Fed finally does do something with rates, as they keep promising to do, it may be the one thing that takes us out of this trend. But that being said, until they do, it remains the 500-pound gorilla in the room. And as long as it's there, it just seems like it's going to keep us in that range.
All right. As always, thank you very much.
Always a pleasure, Jill. Thanks.
For TheStreet in New York, I'm Jill Malandrino.